In this video we learn about Goodwill and tips of valuation of Goodwill. Before we start, please like, share and subscribe Arjun Productions. And also don't forget to hit the bell icon.
Goodwill in accounting is an intangible asset that arises when a buyer acquires an existing business. Goodwill represents assets that are not separately identifiable. Goodwill does not include identifiable assets that are capable of being separated or divided from the entity and sold, transferred, licensed, rented, or exchanged, either individually or together with a related contract, identifiable asset, or liability, regardless of whether the entity intends to do so. Goodwill also does not include contractual or other legal rights, regardless of whether those are transferable or separable from the entity, or other rights and obligations. Goodwill is also only acquired through an acquisition; it cannot be self-created. Examples of identifiable assets that are goodwill include a company's brand name, customer relationships, artistic intangible assets, and any patents or proprietary technology. The goodwill amounts to the excess of the purchase consideration, the money paid to purchase the asset or business, over the net value of the assets minus liabilities. It is classified as an intangible asset on the balance sheet, since it can neither be seen nor touched. Under US GAAP and IFRS, goodwill is never amortized, because it is considered to have an indefinite useful life. Instead, management is responsible for valuing goodwill every year and to determine if an impairment is required. If the fair market value goes below historical cost, what goodwill was purchased for, an impairment must be recorded to bring it down to its fair market value. However, an increase in the fair market value would not be accounted for in the financial statements. Private companies in the United States, however, may elect to amortize goodwill over a period of 10 years or less under an accounting alternative from the Private Company Council of the FASB. Modern meaning. Goodwill is a special type of intangible asset that represents that portion of the entire business value that cannot be attributed to other income-producing business assets. Tangible or intangible. For example, a privately held software company may have net assets, consisting primarily of miscellaneous equipment and/or property, and assuming no debt, valued at $1 million. But the company's overall value, including customers and intellectual capital, is valued at $10 million. Anybody buying that company would book $10 million in total assets acquired, comprising $1 million physical assets and $9 million in other intangible assets. And any consideration paid in excess of $10 million shall be considered as goodwill. In a private company, goodwill has no predetermined value prior to the acquisition; its magnitude depends on the two other variables by definition. A publicly traded company, by contrast, is subject to a constant process of market valuation, so goodwill will always be apparent. While a business can invest to increase its reputation, by advertising, or assuring that its products are of high quality, such expenses cannot be capitalized and added to goodwill, which is technically an intangible asset. Goodwill and intangible assets are usually listed as separate items on a company's balance sheet. Types of goodwill. There are two types of goodwill: institutional, enterprise, or professional, personal. Institutional goodwill may be described as the intangible value that would continue to inure to the business without the presence of specific owner. Professional goodwill may be described as the intangible value attributable solely to the efforts of or reputation of an owner of the business. The key difference between the two types of goodwill is whether the goodwill is transferable upon a sale to a third party without a non-competition agreement. Now we will learn about methods of goodwill valuation. Goodwill is the value of the reputation of a firm built over time with respect to the expected future profits over and above the normal profits. Goodwill is an intangible real asset which cannot be seen or felt but exists in reality and can be bought and sold. In partnership, goodwill valuation is very important. Thus, we will here discuss the various methods of goodwill valuation. Goodwill valuation. A well-established firm earns a good name in the market, builds trust with the customers and also has more business connections as compared to a newly set up business. Thus, the monetary value of this advantage that a buyer is ready to pay is termed as goodwill. The buyer who pays for goodwill expects that he will be able to earn super profits as compared to the profits earned by the other firms. Thus, goodwill exists only in the case of firms making super profits and not in the case of firms earning normal profits or losses. Goodwill is recorded in the books only when some consideration in money or money's worth is paid for it. Thus, in the context of a partnership firm, the need for valuation of goodwill arises at the time of 1. Change in the profit-sharing ratio amongst the existing partners. 2. Admission of a new partner. 3. The retirement of a partner. 4. Death of a partner. 5. Dissolution of a firm where business is sold as going concern. 6. Amalgamation of partnership firms.
And now we will learn about
methods of valuation of goodwill. The choice of the method of goodwill valuation depends entirely on the partners or the partnership deed when they have made it. 1. Average profits method. I. Simple average. Under this method, the goodwill is valued at the agreed number of years of purchase of the average profits of the past years. Goodwill equals average profit x no of years of purchase. 2. Weighted average. Under this method, the goodwill is valued at an agreed number of years of purchase of the weighted average profits of the past years. We use the weighted average when there exists an increasing or decreasing trend in the profits giving the highest weight to the current year's profit. Goodwill equals weighted average profit x no of years of purchase. Weighted average profit equals sum of profits multiplied by weight/sum of weights. Explore more about treatment of goodwill. Treatment of goodwill. Accounting treatment of goodwill. Death/retirement of partner. Accounting treatment of goodwill. Change in PSR. Accounting treatment of goodwill in case of admission of partner. Concept of goodwill. Super profits method. I. The number of years purchase method. Under this method, the goodwill is valued at the agreed number of years of purchase of the super profits of the firm. Goodwill equals super profit x no of years of purchase. Hashtag super profit equals actual or average profit, normal profit. Hashtag normal profit equals capital employed x, normal rate of return /100. 2. Annuity method. This method considers the time value of money. Here, we consider the discounted value of the super profit. Goodwill equals super profit x discounting factor. 3. Capitalization method, I. Capitalization of average profits. Under this method, the value of goodwill is calculated by deducting the actual capital employed from the capitalized value of the average profits on the basis of the normal rate of return. Goodwill equals normal capital, actual capital employed. Hashtag normal capital or capitalized average profits equals average profits x, 100/normal rate of return. Hashtag actual capital employed equals total assets, excluding goodwill, outside liabilities. 2. Capitalization of super profits. Under this method, goodwill is calculated by capitalizing the super profits directly. Goodwill equals super profits x, 100/normal rate of return.